Bitcoin just dropped to $60,000. And this time, the move didn't look like a typical crypto crash. There were no major macro headlines, no regulatory announcements, and most importantly, no massive liquidation cascade on crypto exchanges. Retail leverage stayed relatively calm, yet the price still fell sharply. That immediately raised a key question. If leverage and exchanges weren't the cause, where did the selling come from? The drop happened on February 5th and marked one of Bitcoin's steepest single-day declines in months. What made it unusual was how little stress showed up in the usual places. In past sell-offs, forced liquidations amplified downside momentum, pushing prices lower in rapid succession. This time, liquidation data suggested a muted response, which implies that over-leveraged retail traders were not the main drivers. Attention quickly shifted outside crypto-native markets, particularly toward US-listed spot Bitcoin ETFs. On the same day Bitcoin fell to $60K, iShares Bitcoin Trust, BlackRock's spot Bitcoin ETF, recorded roughly $10.7 billion in trading volume, the highest daily total since its launch. At the same time, options activity linked to the ETF surged. Volume of that magnitude is typically associated with institutional investors rather than retail traders, which made the timing hard to ignore. High trading volume alone doesn't tell us whether money was flowing in or out, but it does suggest aggressive repositioning. Some market participants believe that institutional de-risking or adjustments to options strategies may have contributed to selling pressure that eventually showed up in Bitcoin's spot price. If large options positions tied to ETF exposure were reduced or closed during a period of falling prices, that activity could have indirectly weighed on the broader market. Another detail that stood out was how different assets moved together. Bitcoin and Solana declined at a similar pace, even though Solana is usually more volatile. This kind of synchronized movement often points to broad coordinated selling rather than isolated crypto-specific stress. Reduced liquidity during certain trading hours may also have magnified the impact of those trades. Some speculation has focused on hedge funds that appear, based on delayed regulatory filings, to hold highly concentrated exposure to IBIT. In this framework, funds are structured around a single strategy or asset, a concept sometimes described as risk isolation. If losses mount or risk limits are reached, selling can happen quickly, even without any public warning. If such funds were also exposed to leveraged options tied to the ETF, short-term selling pressure could spill into Bitcoin's price without being immediately visible on crypto exchanges. Because much of this activity would take place in traditional financial markets, it may explain why the move caught many crypto traders off guard. Selling driven by ETFs or institutional portfolios doesn't show up on-chain in real time and doesn't look like the classic exchange-driven panic. Some data providers have noted broader net selling by institutional cohorts, but this still doesn't prove a direct link to the February 5th drop. At the moment, there is no definitive evidence that ETF-related activity caused Bitcoin's brief dip to $60,000. The idea remains speculative and should be treated as such. What the episode clearly highlights, however, is how much Bitcoin's market structure has changed. As spot ETFs, options, and institutional strategies continue to grow, Bitcoin's price may increasingly reflect forces coming from traditional finance rather than purely crypto-native dynamics. In that context, the move serves as a reminder that sharp price swings can occur even in the absence of obvious news, leverage-driven liquidations, or on-chain stress signals. Bitcoin is becoming more intertwined with global financial markets, and with that evolution comes a new set of drivers that investors need to pay attention to.